those purchases are the purchases that has been occurred on a credit basis. Money has not been paid on the spot. By doing that, we are also raising what we call is a general ledger. From the general ledger, you are expected to deal with the issues in terms of a tier account, which we'll be able to explain probably on the next week in terms of a practical exercise, how to draw up the tier account. But for now, let us dispose the theoretical part. So when you deal with the inventory, we agreed that trading stock is your asset. If your trading stock is your asset, what does it mean from the accounting perspective? Trading stock are increasing under your debit side. Your trading stock are increasing under your debit side. Then your trade payables will be decreased, will be increasing under the debit side. So we need to make a practical exercise for that, to make sure that the purchases account is debited, because there's an increase in terms of your trading stock. There's also an increase in terms of your trade payables. When they say it's a trade payable, these are your creditors or these are your suppliers. So when these accounting terminology comes in, but when they talk about trade payables, it means that they are referring to trade, they are referring to creditors, they are referring to your suppliers. Your trade payables, the name payable, it means that is not yet paid, but is due for payment, hence is payable. Obviously, there's also an extended element in terms of the purchases. Sometimes you are not happy in terms of what has been delivered for various forms, whether the product that has been delivered is damaged or the product that has been delivered is not in accordance in terms of the initial specification. So what do we do under those circumstances? We have to return those goods. When you talk about these goods are your trading stock, we have to do returns. And in terms of recording of those transactions, what do? You record in terms of your purchases returns journal. Obviously, this bullet will reduce whatever that has been recorded in terms of the previous bullet. When you receive these things, which are 15 in total, but you decided to return 3 items, obviously the 15 minus 3 will be affected, but through an accounting methodology, not in a straight line. You can't be 15 minus, but you need to do you need to make some reflection in terms of your debit and credit to make effect of the returned goods. So these are the aspects that keep your recording, and all these recording, ultimately you should be able to communicate to the users of the financial information, but make sure that there's a proper recording for this. I think I must a little bit pause for that and allow colleagues just to come up with a practical example so that we can be able to really understand when you talk about the asset, you are talking about what, and what could be the accounting implications in the case of, purchases that has been effected, and what are the implications in the case of returns that has been effected. Can we allow any volunteer? I think the same principle that we adopted last time, to say there is no wrong or right answer at the present moment. All of us, we are here to engage so that we can prompt, a high level of knowledge development on the subject matter. Anyone that can come up with an example of the inventory, regardless of the business type, so that we can be able to put an articulation to say, this is the inventory purchased from where and resale to whom, and what are the implications in terms of the accounting. Can we attempt, please?
Could inventory be something like if I buy cold drinks for a stall?
Yes, correct. Let us say you've got a tech shop, and this tech shop is selling a number of items, and one of those is a cool drink, could be Coke, could be a Sprite, could be a Stone. That particular item is an inventory. Where does that particular item coming from?
You could buy it from a wholesaler like Macro.
Exactly, like micro. How do you call micro in this context?
Please repeat.
What do we call micro? We call it, I mean, we want to make a practical example and attach, the appropriate accounting terms. I agree now, you've got a tech shop, we are selling this cool drink. It's either you are selling to the community members, those community members are your customers. In accounting, we call it your debtors. Now, let us put a clarity in terms of micro. Let us use this particular example. There is wholesale.
Supplier.
A supplier.
Micro would be our creditor.
Exactly. In this context, micro is our creditor. Is our creditor. Alternatively, we call it is a supply. But in this context, macro is our own creditor. Is our own creditor in what context? Micro we have not purchased on cash basis. We purchased through the credit terms to say, give me this in bulk, and you take this, you make sure that when you reach your tech shop, you sell in terms of the individual items, you sell to the community members. Community members are your debtors, are your customers. But micro is your supply, is your creditor. But in accounting terms, your trading stock, you will increase under your debit side, knowing from the fact that this stock is not buy once. Immediately that you reach a particular level, you reorder. But in terms of the accounting treatment, your stock will increase under your debit side. It means under your left side, in terms of your T account, we will do a practical exercise next time in terms of the next section. But your creditor, which is micro in this context, will increase under your credit side. So for your accounting to be balanced, you have two double entry that you must be implemented. There must something that must be done in your debit. There must be something must be done in your credit so that you can be able to balance. So hence in accounting, we call it debit, we call it credit. In terms of the accounting, debit is indicated in terms of your positive side. Credit is indicated in terms of your negative side, but we'll do the practical example. But it's important that you must know that there's always two actors in the accounting. In this example that we have an example of somebody that is owning a spaza shop, dealing with the cool drinks, which is a businessman or a businesswoman dealing with that, but is buying in bulk for purposes of reselling in terms of the individual items and how to treat it in terms of the accounting books. Let us say now you bought these items from your macro, but when macro delivers, you can see that 10 of them has been damaged to the extent that there is no cool drink, it's only the empty. So under those scenarios, we have a responsibility to make sure that whatever that is being delivered in your business site, there's someone that should take responsibility to record, to make some reconciliation, to say, we ordered this, is it in the right condition? Is it the brand that we ordered? Because we ordered Coke instead of Sprite. The Sprite we still have in the shop and is dominating there. There is no need for this. But we have not ordered for that matter. We ordered this particular brand. What do we do? Then under those circumstances, we have to return back those line items, but we need to deal with the purchases return journal, because it's not just deal with the physical part to put in your truck and deliver back, but there must be a process of recording in terms of the books of your business. So that is how this aspect need to make sure that has been considered. This one has got the implications if your purchases was also implicating your VAT component. You also need to take into consideration your VAT component during your return processes to make sure that there's a proper recording. Let us look at this aspect now. In terms of your discount. I explained that you are at a center. We are the business person, you are at a center. You buy for the purpose of reselling to the customer. Anyone that's got understanding in terms of your discount, trade discount, what your understanding of trade discount? What is your understanding of your trade discount? Anyone can come forward and put some clarity to say what is a trade discount in your own view. Trade discount. Your hands is up, Tanganani. Trade discount.
Thank you. I think trade discount is the agreement that happens between the person that is selling to me the bulk, because I'm buying in bulk, to say this is the price, but we're going to reduce it for you because you're buying in bulk and give you this bulk in this much price. This is what I think.
100%. 100%. 100%. Any other view? Yes, Sihle. Yes, Sihle. It's quite correct. Yes, if you look at how the guys from, I'll call it from, if you look at the township arrangement, there are these guys who've got shops, but they likely to work together, to say, for us to enjoy discounts, let us go to wholesale, and buy on bulk basis, and knowing very well when we're coming back, we're able to distribute these trading stock according to the number of smaller shops. But they make sure that there's a discount that is being enjoyed when you buy in a bulk basis. But critical for this, we must know that how to make an appropriate accountability in terms of the financial records. In terms of the accounting, when a trade discount is being offered, how to treat it in your own business. Anyone that is aware in terms of the economic surplus, anyone is aware about that term, economic surplus? We are expected to buy these, bulk items at 1,000 rand, but whatever the reason might be, you buy at 900 rand. So, for accounting purposes, how do you treat, how do you treat the 100 rand, the discount offered by the supplier? How do you treat it? Remember, this is the money for the business. You go there to buy at 1,000 rand, but whatever the reason might be, your supplier said that I will offer this, my friend, at 900 rand, because you are the good customer, you've got good relations. How do you treat the outstanding? Will allow, Tangana will also allow the other student. I can see there's a number of hands. How can you treat it?
It's a bonus, and I believe that's a surplus we're talking about. It was supposed to work, but it did not work. So it will increase. It will go back to my business, and it will be the money that I'm going to invest. Otherwise, it's a bonus. So I believe that's a surplus.
Okay, excellent. But in terms of own accounting, we'll treat that as an income. It's not an income per se, but in terms of the treatment, I know I'm supposed to spend more, but I end up spending less. But it doesn't mean this money must not be appropriately accounted for in terms of the accounting books. We treat it as part of the income. Let us allow, there was another hand. Elmon.
No, thank you very much. I was going to say that it should remain as a business equity, because I had thought that when you use money to buy inventory, you are reducing equity, so it remains there. But I hear your explanation. Thanks.
Just hold on the surplus. We'll change the game of the rule, such as to connect your comment and the comment from Tangan. Tobile, what is your view?
I actually just have a question, sir. Why would
Yes.
you treat a trade discount as an income and not as a current asset, maybe?
Okay, Tobile. Let us take for note for that. There's a hand up. There's another hand up. Okay. You will see the answer there, simple. Now this discount is offered to you as a business. It's a trade discount that is offered to you as a business. Let us put another example now. I said that we are at the center of the business. We just visualize that there's a straight line. We are at the center. We are at the center. You buy for purpose of reselling. Let us use an example of a Coke. This Coke is either, don't mind about the size, but let us agree you're selling out at 25 Rand. Whatever the reason might be, you decided to sell it at 20 Rand. Your community member, you decided to sell it at 20 Rand instead of 25 Rand. Let us provoke debate, which is similar. Now, is you offered a discount to a customer. Instead of selling this Coke at 25, you're selling at 20 Rand. How do you treat the 5 Rand? Yes, Tangan.
Again, as I said, it's a bonus. So this money already, I calculated it. It is 25 Rands for the Coke. But by chance, I got the 5 Rand back to me. So this is a bonus. For me, it came into my account, back into my account. So that's equity. It increases my balance.
Yeah, yes. Look on this one now. It's a little bit different to the previous example. I'm saying the previous example said, we are the business owner, you are offered a trade discount by your supplier. But this example now is you who are offering a discount to a customer. You are expected to sell the Coke at 25 Rand, but you're selling at 20 Rand. What could be your explanation of the 5 Rand?
For me, it's an expense.
Zinhle and Ishmael, followed by Tanganani and Zahara. Yes.
So you said the Coke is 25 rands, right? And then if you
Yes.
discount it to the customer, you give the customer by 20 rands. So that means it'll be an expense because you're losing out on the 5 rand now as a business.
Yes, yes, 100%, 100%. So let us allow Zintle. Zintle, can you also attempt, please?
Yes, sir.
Yes,
Must I
please.
make an example?
Yeah,
So,
I think the previous speaker is spot on. So I just want, if you want to make some addition or with a different view, because what I want to make sure that is clear. When do you recognize this as an income? And when do you recognize discount as an expense? You see, when it's you, the business offered, it results as an expense. Because if you are selling a Coke at 25, it means that your profit was expected to be 25 rand. But somewhere, somehow, you decided to let me just offer at 20 rand. Because the weather condition is cold, maybe whatever. So the stock is not moving with the pace that is expected. So let me discount it. In essence, there's a loss. In accounting, we treat that difference as an expense. But if it's your suppliers that offers you a discount, you treat that as a benefit, as an income. So we have not yet reached now the slide that I'll be able to articulate more when it's you that is offering a discount to the customer. But I just want to make a practical example so that you can easily recognize at what stage this we have lost, at what stage that we have gained. So I'm happy with the clarity that has been provided at the present moment. So we recognize this is a trade discount that is allowed by wholesalers. So wholesalers, to keep relationship with us, there are certain benefits that are being offered. But those benefits don't take and put in a pocket, but you put in a business by creating an appropriate recognition so that you can be able to have appropriate accountability. This one is the one that we partly engage on, in terms of your debtors. At some point in business, there are certain discounts that are being offered, just to encourage you. For example, if we are expected to pay your account in 3 months fully, whether you've got a clothing account, whatever, but whatever the reason might be, you decided to settle it in a 1 month period. And we call it a settlement discount. This settlement discount can be at the side of the supplier, can be at the side of the customers. But the accounting treatment is not the same. So if customers got the account in your business, you agree that you are selling, you've got these parcel shows, but there are people that you are offering your product to say, take this and come, at the end of the month. But you can see this gentleman is honoring his or her account. There are certain discount settlement that are being offered. But in terms of the accounting treatment, you should be able to know how to treat those accounting settlement. Basically, on this second example was directly relating for this. This one, when you call it, is a sales journal. I'm actually referring to you selling out to your customers. Whatever that is being sold out to your customers must be able to record it under your sales journals. Your sales journals are recording issues that has been purchased in terms of credit. You recording here, we call it that journal as a sales journal. Equally applied, if you cannot be happy on the aspect delivered by your suppliers, even your customers. What if by chance you are selling a drink, a cool drink, but unfortunately you have not been able to identify that there's a factory fault? But now customers maybe is coming back to say, look, the product that you are selling for me is, when you look at the expiry date, you know, it's bad. It's not supposed to be, it's not good for consumption. Therefore, I'm returning back this, item. Therefore, you must refund myself and so on and so on. But those returns, we are recording under the sales return journal. So you need to be careful on this, to say, if you are selling a complete product, what journals are being used for purchases from the suppliers, from the wholesalers? What journals are being used? We've got purchases journals, we've got returns journals, and what events that triggers the purchases returns, what events that triggers the compilation of the purchases journal. You must know. Now that your stock and in your shop, we are selling out, what journals must I open for selling to customers? And if customers unhappy are retaining particular product, what journals is your sales returns journal? That must be recorded to make sure that all other aspects has been taken into account in terms of the journalization. I can see there are hands that are up. I'm not sure whether they're the latest one or, but let us allow them to deposit their comments. Zara, your hand is up.
Hello. Hi.
Yes, Aligasua.
I wanted to know, I came late in, so I wanted to know if I can go again back to go watch the video.
Come again?
I joined late.
Okay.
Now I wanted.
Okay. Yeah, I think the issue of the recordings, because I'm looking at my computer, it's on, you know. Probably for those who are advanced in technology, they are already will be able to access it. But there's an official point of communicating. You can engage Mr. Koyana directly from the varsity to assist the process. But in my previous life, I've noticed last semester that students can be able to share these things so quick. But if that is not working at the present moment, you can have a direct interaction with the varsity to assist. But I can see from my computer the recordings are on. Our session is being recorded as we proceed. Okay. Yeah, I explained for this what could be expected. This directly relating to your customers in terms of, you know, how to record transactions that in case that we are selling out, and if customers is not happy, what transaction you should be able to look at. Ultimately, these customers, we should not also be confused in terms of the previous slide. We talk about trade receivables. When it's you and your customers is sometimes are being called as a trade receivables. We must know that this is your debtors. This is your customers, you know. We call it is a trade receivables. In terms of the accounting, when you are selling out these aspects, you debit the trade receivables. You debit your trade receivables because there's an income that you're expected to generate in terms of selling out this aspect on credit. Then you credit your sales, or you credit your income to make a recognition. in terms of your accounting records. This is what you are expected to address it in terms of your books. When you talk about general ledger, it's just what I indicated above, that these aspects are classified in accounting. We've got assets. When you talk about assets, assets are enjoying a debit balance. If you buy your trading stock, if you sell your items to your customers in terms of your debtors or trade receivable, all of them are enjoying a debit balance, Now, the issue that we also now to take into consideration. Now, this customer has got an account to your business, whatever the reason might be, decided to disappear. Many reasons for disappearance is either this person is unemployed, is avoided, but is unemployed, the credibility, the capacity to pay is no longer there, or this person is diseased. This person is diseased, is no longer able to service the account. What do you do under those circumstances? What do you do under those circumstances? This person has expected to pay over the account, but is no longer paying. The business decided to close off. And if this person is still alive, it's just that the employment, has got challenges of the employment contract has been expired. But whatever the reason, 6 months down the line, this person has been reappointed. What are the implications of those factors in terms of the business? Let's allow the people to have the engagement, whatever the way that you want to chip in. Let us say now we are expected to pay over your account, and your account was 1,000 rand, but this customer is no longer servicing it. And this customer, the issue of financial challenges, is unemployed. How do you treat an account of someone who's no longer around, is no longer servicing? And you decided as management of your business to close off this account. Let us close off this account. Shengwe?
By my understanding, I think that the account would be written off as a bad debt. I think that that would be a liability and that would be credited, but I'm not sure what the other account would be.
Yes, Tanganani.
I've got a little bit of a different view on this one.
Yes.
The first thing is, why do we write off a debt of a person who is unemployed today and employed again next month? Can we not look into cases differently and say he's dead, he will never be alive? But he's unemployed, maybe he can be employed next month, and we hang that debt.
Yeah. Let us take that particular example. This person is deceased.
The person is diseased, this is my loss. So it will go into the expenses. That's what I think.
Okay. Any other comment? Yes, Pumzina.
I think that if a person is deceased, the person is no more. So that debt that was owed, it will be written off because that person is no longer alive. Who would pay for the expenses?
100%. Ndozela. And Muzira, followed by Muzira.
So it would be debt write-off, and it will be journaled under profit and loss.
Okay. 100%. Yeah, I think there was a hand Can we also allow the last one? Yeah, I think there's a fair comment on this one. you see there are a number of yes, Zintle, you want to come back?
So what if if a bank or like the person's possessions can be sold and then the amount can be paid? Because in some cases the bank repossesses the house or other things of that person to repay their debts.
You see, I like your point of view because it's coming from the legal perspective now.
So
Is coming from the legal perspective. I'll comment on that. I'll comment for that. I like it because now we are connecting for this to other legal provisions. As you progress with your curriculum, we're going to talk about the insolvency law. If someone becomes insolvent, but is becoming insolvent, but when you assess this person in terms of asset versus liability, there's an equity. There's an equity that creditors can tap in. But what is the legal process in relation to that? Because you cannot just come to me and repossess. What is the process? But before we engage on that, on this, you know, this person is okay. Let us allow Tango. Tango, your hand is up. And Babongile.
Yes, correct, sir. Hello, everyone. I'd like to check here, sir. What if a person is deceased, fine, and then I write off the debt, and then it's later found that the person is not actually deceased, maybe faked his own death or whatever? What do I do as a business?
Yes. Thank you very much. Let us explain the first component. I think there are three in total. You know, let us take this example of a deceased. This person has opened an account for me. In order for me to say this person is deceased, there are particular documentation that I must have an access to, e.g. the death certificate. So if a death certificate for this particular customer, I have solid ground to say, let me write off possibilities to recoup my money are not there. This person is not alive anymore, is deceased. You can write off, you know, but the write-off will impact in two different forms. You reduce your customers by taking out this disease data because no longer being part of your data's book. But if there are interest that will due to be paid by this diseased person, you expense those ones as a credit loss. You expense this as a credit loss because they have lost, you have been written off, you know. But I like the argument because before you say this person is unable to pay and must be written off, what are the necessary documentation that must be in front of you in order to make that determination? Because this determination should not be an oral issue. For accounting perspective now, this component. Let us come now. Let us change the story. I'm coming to this of the recoupment, the third one. This, you know, person, we don't know whether is deceased. We don't know what happened. This person is just disappeared, no longer coming. But because of the time period, maybe an accounting policy says that if someone did not pay the account after the period of 3 years, that person must be written off. It's an accounting policy. But whatever the reason might be, maybe an IT expert decided to advise us to say, look, let us invest on the ICT system. our ICT systems will be able to punch the data of our own customers and will be able to tell us whether this person is still in the service of the state or not. But when we embark in that particular exercise, we're becoming aware this person is working somewhere in Gauteng. Probably the legal department now is beginning to engage to say, your account was handed over to us. We are Mr. Banban or Mrs. Banban from this particular legal firm. We are mandated to make some collections. We are owing this particular company so much. Fortunately, this particular gentleman or woman agreed to say, I'm aware about that account. Unfortunately, I was not employed for the couple of years. I changed the province. I relocated to Cape Town, but now I'm here. I'm just getting a job. I'm 3 months now in this particular job. Can we do an arrangement to pay off my liability? And there's an agreement in between to say I'll pay off. Now, if now this person now agreed to that, if he has begun to pay over the amount, how do you treat it? Under those particular circumstances, we classify that as a debt recovered. As a debt recovered. We classify that one as a debt recovered. In a literal sense, it's a restatement. You restate this person under the books. If it was written off, you reverse that. Whatever the amount that has been, paid off, we recovered. We call it as recovered. Let us come now to the last leg and the most difficult one. And the most difficult one. Now, I'm still alive, but I've got assets. But at the same time, unable to pay over or to service my debt. In terms of the insolvency law, the suppliers or your creditors are allowed to approach the court to actually declare yourself as the insolvent. Once the court order has been granted to declare this particular customer as insolvent in what context? Is unable to discharge its own financial obligation. Once the court has granted that, they normally appoint what they call it, it's an executor, someone that will take over your financial affairs. This particular person now will have a responsibility to say, if we match up your asset versus your assets, your liabilities, is there any remaining? If there's a remaining in terms of your asset minus liability, there's some money that has been remaining. There's always a convening of a meeting. All creditors will be called under one roof to say, yes, we are aware that this particular customer is owing you. But in terms of the court order, it has been declared as insolvent. Once you've been declared insolvent, it means you're unable to pay your own issues. But when you match up your asset versus liability, this is what we can remain. This particular meeting must agree. This person might not be necessarily able to set off all the account, but let us agree in terms of the ratio. Because if I owe you a 5,000 rand, I cannot get a similar share, in terms of someone that you own a 10,000 rand or a 15,000 rand. So a kind of equitable way to redistribute what has been remaining to pay over your creditors. But it's quite a branch of law that is quite inciting. But that is how it's being done. Because to me, it doesn't make sense that you are able to pay me, but you can see you still have assets. What legal processes that can be activated to make sure that we've got access to them? For example, somebody's got pensions. Yes, there's no money in the account, but there's this expectation of money that will flow in to a bank account. Or you've got life policies. What do you do? So these are the kind of your legal advice to a particular creditor. To say, yes, I agree, before you write off this person, can we explore these options in order to recover the business money? I also appreciated, colleagues, those comments from the chat box. I've noted for that. Exactly. You see, another terminology of being insolvent is an issue of bankruptcy. When I say you are insolvent, you are bankrupt. But your bankrupt doesn't mean if you don't have money in the bank, you are bankrupt, but you still have properties. What do we do about those things? So another aspect that has been deposited by Koboni. Hence, guys, it's always important that you are the lawyer, you are the attorney, advise appropriately even in marriage issues. If you entered in community of property, once I'm being implicated as a man, automatically my wife is also implicated. If I'm unemployed and that particular business has been advised accordingly, it means my issues, my wife have to pay over my issues. Because in community of property, 50-50 issues. You see? Yes, it's a liquidation and distribution of assets in terms of your declaration of insolvency by the court. We must dissolve your issues, you see. So you see how the accounting linked to law. I'm so excited, guys. I'm so excited because in accounting, we simply just plug figures, but it goes further. It goes further to that. So that is why that is important, that whatever you do must have the legal opinion to advise. But if this gentleman is married out of community, it means that at least the estate of the family is only the 50% that will be implicated. Other 50% is untouchable. Is untouchable because the nature or the regime of marriage dictates that what belongs to the man belongs to the man, what belongs to the wife belongs to the wife. So you will see how these issues interact. Your hand is up, Mafata.
Yeah, thank you so much, Sam. I just want to talk around, you have alluded earlier on around the accounting policy that says if you're not paying in 3 years, the account can be written off. And then you further touch on the definition of insolvency that, if you cannot pay. But then my question comes in around prescribed debt, where it is now not legal anymore for anyone to go and collect the debt because the debt is so old, right? For a person that is still alive but couldn't pay the debt during whatever. So maybe the business went through liquidation or it was insolvent and they couldn't pay. And then time lapsed, the 3-year lapse. I don't know what is after 3 years, is there another time that you can get to repay? When do you then, as a lawyer, or are there policies or laws in place for you to go and collect that money after it has been prescribed? And how do you then record it on either the T table or the general ledgers? Thank you. That's my question, sir.
Yeah. On this one, for example, if a company is liquidated, the subsequent process in practice, a person or a creditor normally goes what they call it at a rehabilitation process. You see, a rehabilitation process, it will goes and goes and goes, but immediately after I'm rehabilitated, whether I've got a job, you are no longer have to come and collect what was outstanding before my rehabilitation process. You see, that is another dynamic. It's just like to say, yes, I have these problems. The court declared me as bankrupt or insolvent. My assets were distributed. I followed the process in terms of rehabilitation. And after that process, yes, now my life and stress level is gone, and my life become normal. I applied, I got a job. You are no longer entitled to come to myself to say, I need to collect ABCD because you owe me and this and that. So that meeting is trying to close up the file. So this person will be declared as will be written off, and that process will be instituted. You can't go back and collect. It's just like somebody that has been declared as insolvent. Immediately that there's a court order, my creditors are not allowed to call me to say you must pay. We'll wait the outcomes of the processes out beyond the declaration order. So that is how these dynamics works. You know, it is just like somebody that is go to prison and serve the prison sentence. After they serve the prison sentence, it's not really important to say historically we have done this and done this and done this, but for accounting purpose, you write off that person and then it's dead. But if this person maybe was handed over to your lawyers, and the account was not fully written off, and the lawyers has managed to identify you and they do some collection method on behalf of the business, contacting your client, making the necessary arrangement with the client, that person is regarded as recovered. In other companies, they just close up the account, not accumulating interest, but to keep it. I don't know whether maybe you put it in a separate account, but they keep it, but without accumulating interest. Even to me, if you are not yet certified debt, might not be necessarily advisable to close everything of that particular person, but you can find a way not accumulating interest to keep it up until you are being certified debt. Hence, in law, they always use even the probabilities. You know, if somebody you unable to identify at a certain period of time, you can apply to court for declaration of a deceased on the basis of probability. This person was disappeared at the age of 60, but now is 30 years now. We're unable to identify. On the basis of probability, we can. So there are those dynamics. I'm trying to bring closer in terms of the legal aspect of it. But in terms of your debit and credit, if you written off, you reduce your debtors. If there's a credit losses, you expense it. But if this person has been recovered, you recognize those debtors and bring back those lost income in terms of your recovered revenues. That's not how it works in terms of your practice. Your settlement discount, we try to touch base in terms of this element to say, what if there are early settlement of the account, what could be in the treatment in terms of the accounting. And our discussions has been highlighted for this. Let us look at this particular chapter now of the VAT. All of us were being implicated on VAT. the VAT. Anyone want to lead us on this particular chapter, the VAT? But critical on this, let me just articulate it at high level. For government to be able to generate money, they impose taxations. One of the taxation is a VAT. VAT is a value-added tax. Value-added tax is imposed in two options. There's an input VAT, there's an output VAT. It would be critical for you to say, who is liable to pay input VAT? Who is liable to pay output VAT? If we look at the example that we have used, we said that you are at a center. When you are buying in bulk, your macro, your supplier will charge you input VAT. But when you are selling out to your customer, you will charge output VAT. Output VAT versus input VAT ultimately must have an indication whether the South African Revenue Service, how much money is expected to be paid, or the South African Revenue Services, how much money is expected to refund you as a business. If you go to shop, you can see your slip at the bottom there. There's a VAT component. VAT component in South Africa is 14%. What is the VAT rate in South Africa? 15%. Meaning that if you bought an item at 100 Rand, excluding VAT, when you include VAT, it's 115. Meaning that whatever the product that you sell out, your customer will pay that product inclusive of VAT. Equally, if you buy these items from your suppliers, if 200,000, you have to also calculate your VAT component. VAT component will be 30 Rand in that context. Therefore, you pay a 230 in that context. So, but what I will want you to be critical of, you should make sure that, how do I know this is an input VAT? How do I know this is an output VAT? What if the amount it says is VAT is not included? What is expected to me? We have to calculate it. We have to calculate it. We have to calculate it. I explained this is a formula, it's a formula, to say, understand who is liable for the output VAT. And output VAT is being levied, on the sales of goods or services on the basis that can be rendered by the business. It means that whatever that is being sold out to your customers, you are entitled to charge the output VAT. Whatever that is being, payable to your suppliers, you are entitled to pay you the input VAT to your suppliers. But critical to that, in order for you in South Africa to charge VAT, you must have the turnover that is 1 million and above. Then you will be expected to go to SARS and also do some proper registration to make sure that you are a VAT vendor. Not all of us are allowed to charge VAT. So it's important to make sure that for you to make a determination whether there are possible refund or amount payable, there are these mathematical calculations that you also need to apply in terms of look at the output versus your input VAT. Ultimately, there must be a determination, and that determination be able to give an indication that there's an amount that need to pay over to SARS. But for accounting perspective, if SARS is expected to refund you the business, you recognize SARS as a trade receivables, as a debtor, because it's expected to pay you. So SARS is become part of your asset. But if it's a business itself that is expected to pay over the South African Revenue Services, we are expected to raise SARS as a payable. We are expected to pay SARS at the end of the day, just like you, if you are the employer. When you submit your returns, it's either you get money or you pay SARS the amount that has been owed. That principle is applied even in companies. That principle is even applied to companies. If this company is expected to receive money, you treat SARS as a debtor. But if we are expected to pay over SARS, you have to be treated as a short-term, as a current liability. Yes, Tsepi.
Hi, sir. I just had a question. So if I buy products from like my supplier, so Macro, for example, and those products are inclusive of VAT, but I'm not VAT registered, so I can't sell my products inclusive of VAT. Am I working at a loss? And what does this mean for me in accounting terms?
Yes, thank you very much. Let us also engage those ones that I think in terms of 15.5, yes, the country has decided to discard that increment. Yeah, I think that engagement is good, guys. In terms of companies, Pretorius, VAT mainly is for products or services that we are selling. But companies are also liable to pay a standalone tax, are also paying a standalone tax. Ultimately, companies, I think, is 29% that you need to, a tax liability that you need to pay over. It means that if you generate profit, that profit, Pretorius, need to be subjected to an appropriate taxation bracket. So companies are just like individuals. If you're the employee, there's a tax for individual. But VAT is like consumption. As long that you buy, you are expected to pay a product that is inclusive of VAT. But your question, Debiso, in order for you to be registered as a VAT vendor, you must have a minimum turnover. And the minimum turnover in the South African context is prescribed. It says that at least you must have a revenue. You must have a revenue that is ranging up to 1 million and above. Once is enriching that, we are expected. In fact, it's a compulsory that you must go to SARS to make sure that you are registered as a VAT vendor. But in other instances, something below is voluntary. It means if you've done it or not, there are no punishment in terms of the legal aspect. But if your revenue exceed 1 million, you are expected. In fact, it says that if you got the job that is 1 million and above, within a period of 21 days, you must go to South African Revenue Service and register. Otherwise, you can't charge. You can't charge VAT if you are not a VAT vendor. So if your product is 100 rand, you must charge 100 rand, not 100 rand plus 15%. Otherwise, it would be illegal. it would be illegal for you to do that. In terms of your taxation period, it depends. In other organizations, they talk about your returns, which is an exercise that must be done on a 2 months basis to make sure that there are certain returns. They call it a VAT 201s in South African Revenue Services, to make sure that you comply on that. But in terms of your employees, it's an annual exercise. Let us look at now at the methodologies for charging VAT. We articulated last time in terms of the underlying assumption. One of the underlying assumption was that in accounting, you deal on accrual basis. When you do an accrual basis, what does it mean? You agree to somebody else to pay you in the next 30 days. But we have to, yes, indeed, in terms of your small, medium enterprises, the taxation bracket does differ. I agree on that, because these ones are look at the level of the turnover. Was this? But there's someone that is raising that important aspect. In terms of your small, medium enterprise, the tax bracket is based on the turnover. But your private company, Pty Ltd, the tax bracket is fixed, is 29% in terms of your profits that has been generated in that regard. So I'm saying on this one, you are expected to charge VAT on the basis of invoice. When the invoice is being issued to your customer, the invoice that is being issued must include a VAT component. We know very well that the money has not yet came in the business. It would come in the next 30 days, for example. But for purposes of the VAT, you include on this particular invoice. But it does happen. There are those who are purchasing the product on cash basis. You generate the slip that is inclusive of the invoice. So these are the basis for determination of your VAT liability. It's either you make a determination at the basis of the invoice, or you make a determination on the basis of the payment basis. So these are the methods that are at the disposal. Because if you don't raise your VAT component on the invoice and wait up until you receive money, you are not operating on an accrual basis. So the accrual basis must also take all its own components from now. Let us look at this aspect now of a depreciation, but link this topic to asset. Anyone that is got familiar with the word depreciation, anyone that wants us to engage us on this concept? Babongile, specific.
Okay,
What?
sir, depreciation, it's Babongile here. On depreciation,
Yes.
I haven't worked directly with depreciation, but what I know is depreciation is where, by, let's say, a company has bought a vehicle, and then like 2 years, 3 years down the line, the company decides to sell that vehicle. Just the company should subtract the money in its whole value. The company should subtract a certain amount of money in order to sell it again, so that the company can have money, can have income on that item that is sold.
Yes, I'm in agreement. I'm in agreement. Basically, depreciation are actually engaging the loss of value in terms of your asset. I like the example. You can use this even for your own purpose. If you buy a car and use for the full year, you buy this car at R500,000, but it doesn't mean you want to sell out in the next year. you will sell it at R500,000 because it also lost value. But we classify that value as a depreciation, and depreciation is being treated as an expense for business purposes, is being treated as an expense for business purposes. Anyone that is familiar, for example, building, they are not necessarily, losing value, they are appreciating. But for cars, for equipment, in the form of computers, for furniture, they lose value. And now the accounting policy must be explicit in terms of the rate of the depreciation. Not depreciation can be standard across the board. There are certain percentages that are being used to calculate those depreciation. Anyone's got understanding of the types, there are a number of methods for depreciation. What types of depreciation that we are aware of? Depreciation can be calculated in various forms, but dominantly there are two. Depreciation can be calculated directly, and we classify that one as a straight line method. Depreciation can be calculated in the form of a diminishing method, which is a second method, but I will explain what does it mean in terms of the real world. The straight line method is like this one, for example. Straight line method, we agreed as management to say our vehicles now are depreciating at 15% per annum. 15% per annum. Let us just increase up the value for this so that we can be practical. There's put no car of let us put it, this car is R500,000. R500,000 for this asset. Let us put here so that it can make sense, this practical example. Yes. Don't worry about this one. It's the one that we expected to make a determination. It's us. A straight line method, what does it mean? We've got this asset. Let us for example, it's a vehicle. This vehicle is at R500,000. And we agreed as a management to say, this asset is losing value at the rate of 10%. If this asset can stay over in the business, can stay 10 years. So now, if we are told that the useful life of this asset is 10 years, we've got two possibilities. Is either this cannot be provided for you, you only provided the number of years, or you cannot be provided with the number of years. We can be provided with the percentage in terms of your accounting policy. So now, I want us to calculate a depreciation for year one. This vehicle is losing how much in terms of value? We're using a straight line method. I need year one. Straight line method. Thank you very much, Masafo. What is the value of the asset after year one? Yes, specifically. Is correct. Can we do an example?
So it's losing. Sorry.
Yes.
So I was just saying it's losing 50,000 per year based on the rates of depreciation. So in year one, it'll be 400. It will be worth 450,000 rand.
Okay. So let us do a practical example. Our students are correct. The 10% of 500,000, how much? 10% of 500,000 rand, how much? Lawyers. It's already articulated on the chat box, but I need participation. 10% of 500,000, how much? Is there on the chat box? Other people who were responded on this.
50,000.
So we call this is a depreciation, this one. Is a depreciation amount, this one. So now, what is the value of the car after year one?
Should be
If I
450.
decided to sell, yes.
Should be 450,000.
Exactly. So if I decided to sell out this car, whatever the reason might be, you've got 500,000 minus depreciation amount. Depreciation amount, which is 50. Therefore, the value of the car in year one is 450,000. The value of the car in year one is 450,000. Do you understand? So the formula is this: is a cost of the asset multiplied by depreciation rate. Do you follow this process? If we are required to calculate depreciation, we will be able to do that, Johannes. Okay. Let us change the story now. You are not provided this one, this 10% thing now. We are told the useful life of this particular asset is 10 years. And you are required to calculate depreciation using a straight line method. How do you do? How do you do? You are not given percentage, you're given years now. And we are told it's 10 years. If the asset will be stayed in the business, will stay for 10 years. So how much the depreciation per year? Any attempt?
Wouldn't you divide 500,000 and divide it over the 10 years?
Who's speaking?
Bongiwe Zibani.
Bongiwe is correct, but you must be vigilant in terms of the answering your questioning method. If we are told this asset will useful life is 10 years, it's 500,000 divided by 10. 500,000 divided by 10, how much the depreciation per year would be 50,000.
Oh yes, 50,000.
You see? So you must be vigilant in terms of the questioning method and techniques would likely to, to confuse you, but you must know what you are looking for. So if you are given a percentage, you must be able to use it. If you are given lifespan, you must be able to use it. I agree, it's divided by 10%. So we call this one is a straight line method, this one. It's a straight line method. I think it's a straight line method for this. Let us look the second option. Let us use this one, but keep in mind the previous example. Keep in mind the previous example. Depreciating method, they also call it a reducing method. Reducing method, what does it mean? They look at the cost of the asset. They look also at the existing accumulated depreciation. Before you calculate the depreciation for the year under review, you must look at the cost minus the existing accumulated depreciation. Then you multiply the depreciation rate. Now, let us use this one. Again, let us put 50, let us put 500,000 here. Let us put 500,000 there. We are going to calculate year 2. We are going to calculate year 2. We are going to use the previous answers. 500,000. We agreed that it was 50. It was 50,000. Don't worry about year 1. This is what we calculated. This is what we calculated in terms of the previous example. Now we are required to calculate accumulated, you calculate depreciation using a diminishing or a reducing balance method for year 2. What could be our instance for year 2? We need year 2 now. It means that if we simplify for this, remember the previous example, the value of our own asset was 500,000 rand. We calculated accumulated depreciation at 50,000. Accumulated at 50,000. But if you want to calculate for year 2, you must take the original price and less your previous accumulated depreciation. And the value that will remain is 450,000. Meaning that your depreciation now will be based on 450,000 in terms of your diminishing method. This will be your year 2. What is your what you get 450 times 10? What is your depreciation for year 2? Year 2.
It's
450 times 10%.
45,000. It's 45,000, sir.
I'm in agreement. So your depreciation for year 2 is 45,000. You see, it's 45,000. It means year 1, our asset has lost value at 50, year 2 at 45. Calculate year 3 for me. Using a diminishing method. In fact, for you to be able to make a determination for year 3, make a determination, what is the value of your vehicle at year 2 now? Value of your vehicle, year 2.
That's
What is your value?
405,000.
405,000.
450. Yes. Value of your car at year 2. You can see now this asset is losing value. So what is the depreciation for year 3 now?
$40,500.
40,500.
Yeah. In simple terms now, if you are not provided for this, if you like, you can do this. The value of this car was 500,000 minus 50,000 minus 45,000. 45,000. If you like, you can follow this long process, but it's important to understand the principle. Obviously, this should be able to give us the 405. 500,000 minus 50 minus 45, then it give you 405. Then you calculate now depreciation from here for year 3. How much did you get on your side? How much do you get on your side depreciation using diminishing method for year 3?
40,500.
40,500.
40,500.
40,500. So if you lose this method, you will be in trouble. In basic terms, it says that you use the cost of your asset, you take into consideration the accumulated depreciation. In this context, 50,000 from year 1, we take into account. 45,000 for year 2, we take into account. Then we minus this from the cost, we remain 405. Then we calculate 10% for year 3. So it's tricky. You need to make sure that you master this process, because what will happen, you will be required to calculate depreciation for year 5. You are not calculated for year 1, year 2, year 3, year 4, but you are required to calculate year 4. But you must know what is expected from you. Even here, if you are not given this, but you are required to calculate year 3, know the process that is expected to be followed. So that is how you calculate the depreciation. We're using straight line method. We're also using a reducing method, which is a balancing, diminishing method or reducing method. So that is how this thing is being, done. Will be expected also to look at the issues of the bank reconciliation. I will do the high-level overview for this. We're going to look at in terms of the previous next section, I mean. But your bank reconciliation basically is another chapter that is important in the business sector. Is important in what context? The term is suggesting bank reconciliation. It means there are things that are not agreeing up, are not tidying up, are not linking up. Then there's certain process that need to be activated to make sure that they are balancing. And we call those as a bank reconciliation. These are the grounds that make our bank not balancing. When you say the bank the bank balance at the bank and the bank balance in terms of the books of the business are not balancing up. These are the grounds. Is either the contributing factor is an outstanding check, outstanding deposit, direct deposit, your bank charges. What does it mean? Outstanding checks, for example. If you pay your suppliers by checks, but your supplier has not yet go to the bank and process that particular check, it means in the bank statement is not yet been reflected. Equally applied for your outstanding deposit. Your direct deposit, like insurance does not deduct the money from the business books, but it goes direct to the bank account of the business and makes some deduction of the amount that will be equated to the agreed insurance. Equally, customers are allowed to go to the bank as long that they are using the relevant reference number, so that can be able to be identified during the bank reconciliation stage. Bank charges, banks, impose these charges, but business is not going to be aware up until they download the bank statement and make some reconciliation to make an identification of these charges. Bank reconciliation has got steps. The bank reconciliation has got steps I indicated in terms of these particular grounds, why is either the outstanding checks, outstanding deposit, direct deposit, stop orders, like your insurance. But critically, I want you to understand the steps that are involved in the bank reconciliation. Will be expected to follow these steps. But even this one, it needs a practical part to understand better. But you'll apply these steps during the bank reconciliation process. Step one will be a comparison issue that I will indicate to you your cash receipt journal versus the bank statement. Step number two will be your bank statement or your cash receipt or cash payment journal compared to your bank statement. Then your step number three basically will be look at the adjustment, those aspects that can be identified from the bank statement and those aspects that can be identified from your journals. Then you do the necessary adjustment in that regard. Then you must make sure ultimately your books are balancing up. These are the aspects that I want us to look at in terms of the practical example. By next week, I'll see whether I can be able to organize some practice and see whether we can be able to cover up any aspect that you can be able to understand. I think I'll pause for now for 10 minutes. If anyone that has got question from slide 1 up until the last slide, you can impose that question so that I can entertain those questions from now, because I'm expected to leave the session at 18:45. Basically, I've got 9 minutes left now to entertain your questions so that I can be able to provide some responses in that regard. Over to you guys. From slide 1, if any, or any administrative matter, if I can attempt to respond. And yes, Pile, we'll touch base. We'll touch base on those ones. When is your assignment, your next assignment? When is it?
Tuesday to Thursday, the 12th to the 14th of August.
Okay. Yeah, because I want to push the practical part of unit 3 and unit 4, because it's only the markups which is outstanding on that in terms of how to calculate the profit and loss. But the theoretical part, major of it, I've tried to push very hard on that. But basically, you can look at what is expected from you from the assignment, and then engage me, you know, and engage me, and engage me and see. Because basically, I've noticed from your unit, your unit 3, I think we need to push in terms of the practical side of the bank record. The bank record. The issue of cost of sale is nothing that much from that. But the major part, I think, the aspect of the bank record, we must do the practical exercise and see how to apply it in a real world. Or 12. Is it 12 and 14? Or reducing method, please go over. Okay. Yeah, my brother, on this reducing, but I felt I will share this slide. I will share the slide so that you can be able to go over on your own and over and over. It's tricky for this, but you must practice. What is tricky here? You must understand the logic. Once it says reducing, even here, we're supposed to move to 10 years. But for now, we are still at year 3. It means you can be required to calculate year 5. But make sure that when you calculate the year 5, take into consideration accumulated amount for year 1, accumulated the amount for year 2, accumulated the amount for year 3, for year 4, and cluster like this. You'll add from here. But once you add, you must look at the cost now and take them out. Then will be the cost for year 4. Then you calculate it, your depreciation. But what is important, understand this word. It says accumulated. If it's accumulated, it's which year and which year and which year. But definitely, I will share my presentation. I think I'm part of the WhatsApp group, but I can see we've got so many people for today. But if you look at the WhatsApp group, I think we're less than 50. But I will share the presentation so that you can be able to practice on your own and see. Yeah, I can see there are a lot of discussions from the chat box. Yeah, I like play from your legal side. They call it presumption of death. So there are those dynamics, you know. But it's hard from a pure accountant to understand this thing. It's just that we are fortunate that we are also exposed to, you know, to legally curriculum side, as long that we also engage in terms of the accounting, we're also exposed on that. So for an average knowledge in terms of some of the legal process. Normally, I'm not sure who was assisting because there was a link. There was a link provided on the group. Let me quickly. Let me just quickly check whether I'll be able to find the admin of the group. Just wait a moment.
Someone just shared the link, sir.
Or the link has been shared. Yeah, just use that link. It will help you. I will share the presentation quickly. I will share the presentation quickly. I'm trying to load it now, the presentation. Just 2 minutes. 2 minutes.
Sir, may I please ask a question while you are busy navigating the system?
Sure.
I am just wondering, is the class finished now, or is it going to finish at 7:45?
Yeah, it's finished. We expected to finish at 18:45. If
Oh, there was a mistake on the notice. The notice said 19:45. Maybe there was an error.
yeah, no, it's 2 hours, 2 hour session.
Oh, all right.
2 hour session.
Thank you so much, sir. All right, great stuff.
I normally start at 5:15. I'm expected to deliver the class from 5:15. It's 2 hours. So we are done now. I just want to upload this. Anyone can confirm from the group? I just uploaded now.
We received it, sir.
Yeah, thank you very much. Good night, colleagues. Thank you very much. Thank you very much for your participation. Thanks a lot.
Thank you.
Thank you.
Sure,
Thank you.
thanks. Thank you very much.
Thank you.
Thank you very much.
That was great. That's great.
Thanks.
The class. Thank you.
Thank you very much. Yeah, in terms of the schedule, we started at 16:45 and it runs for 2 hours.
Hello, guys. Anyone in the WhatsApp group? I'm having difficulties to join the group. Anyone in the WhatsApp group who can help me with the slides?
Share your number, Tanganani. What is your number?
My number is too long because I'm in Saudi.
Too long.
Yeah, I'll try to write it here. 0096656412038. I've shared it on the charts.
Sure.
Unless if you can share yours, because mine is really very long.
Okay. Don't worry, mine.
Greetings, sir. Sorry to disturb. I just wanted to ask a question.
Sure.
Would it be not possible to drop the presentation in this chat here?
Okay.
If that was possible, maybe also that would work. But maybe also we need the WhatsApp group so that we can also keep on interacting with other students for some reasons.
Yeah, we'll explore that. We'll explore that, but we want to have one central point so that we encourage even the interaction of you with other people. But we'll explore that. We'll explore that.
Thank you very much.
Sure. So that is my number, guys.
Oh, the 0831.
Yes, 0831. The 0831. The last 4 digits, 4557.
Sure, I see it, yeah. All right. I've sent you a text. I hope you'll receive it. If you can just, I'm not sure if you can add me or you can share the slides.
Yeah, sure, Tangan, I can see. Are you in Saudi Arabia, Tangan?
Yeah, I'm in Saudi.
Okay. No, sure. I will say it now. But Yeah, you can leave now. We can leave now. We are done. We are done. I was just facilitating the uploading of presentation. Unless there's something that still need to be assisted on the presentation part, but I uploaded it. Thank you very much.
Guys, did the class end?
Yes,
Did they record it?
I think so. Yeah.
Okay, thank you.
Has the class started? What's going on? Eletseng ke nna fela ka tlaseng, ha ona batho. Ha ona le titjhere. So, hey, what you waiting for others to join? Hello. Ke Labone. Mama, ke one ka tlaseng, batho ba kae? I ke tsebe ke etse jwang. I'm very confused hore jwale ho etsahalang. Go check the email. Maybe class e cancelletswe. Ha ke tsebe. Hey, keep it to what you're doing.